Welcome to the GEO500 weekly wrap. We have a great guest on. He's been on the longer podcast format before. Ryan Kometz talking about Quant Agri. Welcome, Ryan.
Thank you, Will.
So the format of these weekly wraps is very simple. I will present to you some statistics about how various parts of the publicly traded facet of the geospatial industry have performed, and then we'll have some comments from our special guest talking about something unique, something interesting about things going on in geospatial. So the market overall, the S&P 500 contracted by around 0.5% the past week. The GEO500, however, outperformed, relatively speaking, gaining 0.1%. The GEO400, which is all of the GEO500 stocks except the pure play ones, did the best of all, gaining 0.4%. The pure play stocks, or the GEO100, contracted 1.7%. Esri partners, so these are the GEO500 companies that are on Esri's partner website, contracted 2.1%. The GEO Awesome Top 100 was even worse, losing 4.4%. And the founder-led geospatial companies, sadly, lost 4%. The SPACs, well, we never anticipate much for them, and they, did not fail to disappoint, losing 3.7% in the past week. The worst vertical was hyperscalers, losing 5.4%, matching the overall theme, really, in the market of the past couple of weeks of both semiconductors and hyperscalers, or big tech companies, going backwards as interest drains out of the AI theme. The best vertical was hydrographic surveying companies, gaining 8.6%. My take on that is that oil stocks and oil as a commodity is going up overall due to the latest reinvigoration, if you like, of the war around the Strait of Hormuz. So that then causes companies like Fugro, Oceaneering, etc., to kick into high gear, helping to find oil, firm up reserves outside of that area as part of an overall upsweep in oil stocks. The worst company was Microvision in the LiDAR vertical, losing nearly 18%. The best company was wearable devices in the spatial computing vertical, gaining 170%. A very small company, however, it must be said. The best country was Russia, interestingly, gaining 12%. The worst country was Thailand, losing 7%. Digging into the verticals a bit more, the top five, as I foreshadowed, number one was hydrographic surveying, gaining 9%. Precision agriculture, gaining nearly 7%. Earth observation satellites gaining 5%, shortening the kill chain or defense stocks gaining just over 4%, and data infrastructure gaining nearly 4%. Top five stocks, again, wearable devices, spatial computing vertical, 170%, as I said. Aurora Mobile in the LiDAR vertical gained 27%. Oceaneering, again, hydrographic surveying vertical featuring here, gained 23%. Arcadis, a consulting firm, a really good one, gained nearly 20%. SK Telecom in the map vertical gained just north of 18%. Over to you, Ryan.
Thanks, Will. I'm very interested. I appreciate it. I'm happy to be back on the show. We're bridging the gap between satellite imagery and commodity trading by tracking real-time vegetation velocity, soil moisture, and weather anomalies across key agricultural basins to forecast what the crop stress, map supply shocks, and generate high conviction trade mandates. With that, I'll give the caveat that this is for informational and educational purposes only. It's not financial advice. If you'd like to follow on what we're doing, we offer a free weekly newsletter. It's at quantagri.substack.com. There's also a paid version, and paid users get access to the Quant Agri dashboard. But so why Will has me on here basically is what Quant Agri does is we're using available satellite imagery, specifically mostly Sentinel, a little bit of Landsat, and we're looking at some of the most popular agricultural verticals. And what we did is we started out some paper trading. So we said, what would happen if we took $1,000 and evenly split it out across 6 ETFs? So put in $166 across 6 ETFs. And what would that look like? Well, 7 months, almost 8 months later, it's had a gain, an ROI gain of 19.5%. So that $1,000 grew to almost $1,100, $1,195 to be exact. And really, it's attributed to taking some long only positions and a few tactical exits. And the whole idea is to preserve capital. So by following our algorithms and some of the advice that we came out, we were able to avoid the trap of over allocating to different rallies that eventually stalled. And that's how we were able to preserve that capital. So the ETFs that we're looking at, we look at a corn ETF, we look at a wheat ETF, a soybeans one, and then we're also looking at tags and DBA, which are conglomerations of those. So those are what we follow. That is what we run our algorithm on. The cadence is about every 7 to 14 days. It is not field specific, it is region specific, but we have found that it's working and that we do find an edge to the trading. And so this year is serving as kind of the test year, and we'll be very happy to come back and talk to Will in December to see what the final ROI looks like after 1 year of tracking this.
Amazing, Ryan. What excites me about what you've done is that you've sat there on your own, I think with a bit of a nudge from me in the past year. And here you are, you've got this whole service set up in Substack, and you have genuinely a annualized return of what looks to be 30%, 15%, it has to be said in the first 6 months. So what that makes me want to do is actually to take a position in each of these 6 ETFs, put down, $1,000 across them all, and basically track week by week along with the outcomes or the growth for the stocks in the GEO500. We can also we can track live, as it were, week by week, your performance. Does that sound interesting?
Sounds very interesting. Do it at your own risk.
In TradingView here, I've created a new Quant Agri watch list, and I've got these ETFs. And I've set the chart to start in January 2026 this year. So it was the first 6 months, right? So up until around about here. So here's an example of how overall the soybean ETF, or the value of that commodity, has increased on its own, irrespective of whether someone subscribed to your service and took positions or put money on the table or took money off the table in accordance with what your service said should be done. Just there is an overall gain to the middle of the year here, interestingly, of 14% just with soybean. So that's interesting to see. Corn, the picture is less. It gained 6% to the middle of the year. Wheat gained, well, it seemed to do quite well indeed. Where are we? Where's June? Around about there. That was also about 14%, somewhere there, to the middle of the year. Cane, where are we? It gained, 2%, so that was less convincing. And then tags and DBA, are these sort of somehow the overall farming activity, or what's going on with those?
So they include a portfolio mixture of several agricultural commodities.
Yep. Okay. All right. So that one gained to the end of June, which is where I should have been waving my mouse. This is all very approximate. 3%. And DBA is similar, is it?
Yes.
Yeah, okay. So that one gained of the order of nearly 4%. Okay, so then there's only a couple of those ETFs that gained something like the 15% for the first half year that your service did. So that to me says that if you just took a bulk position or an equal weighted position and held, you wouldn't necessarily have returned that 15%. So then that shows that possibly the signals you're giving with your analytical service are worth paying attention to. All right, cool. So we've looked at the charts. We've got the tickers. There's a soy B, corn, WEAT for wheat, cane, CANE, tags, and DBA. What I can do in the coming week is to faithfully put that money down across those ETFs. We might have some chatting in the background to understand the precise allocation across them. And then, yeah, we'll figure out how I will be updating my positions as we go forward, and I'll report, the result each week. So once again, thanks, Ryan.
Thanks for having me. Well, I appreciate it.